Hello and welcome. You're watching ET Markets. I'm Tanya Aneja. Well, markets continue to remain volatile as we are not out of the woods yet in terms of global geopolitical tensions and recessionary fears. So, what should you do to maximize returns? What are the factors one should consider for diversification? And what should be the ideal asset allocation strategy? To discuss this and much more, I'm going to be joined by a very special guest today. Mr. Feroze Azeez of Anand Rathi Wealth is joining in. Thank you so much, Mr. Azeez, for joining us on ET Markets. So let me start by asking you that do you think equity is too risky for some investors? I mean, markets continue to remain volatile, and I'm asking this for the investors who are having moderate risk appetite. So how should they maximize returns with lesser risk?
See, Tanya, to my mind, equity is right for everyone.
Okay.
Will I have equity in my portfolio till my last breath in this lifetime? For sure. There is reasons for that. Point one is that equity becomes nil or negligible risk with time. By which I mean, we did a study on the oldest equity funds in India, which is 30 years.
Okay.
And then saw the most unluckiest 10-year investor has made 11 to 12% per annum in 10 years.
Okay.
If the unluckiest 10-year investor is double digit, the only thing a person needs to decide is, can I invest for 10 years? And that's a decision who takes? The investor takes.
Absolutely.
Not anybody else, right? Your friend doesn't take that decision for you. You take that decision for yourself. Can I invest for 10 years?
Yeah.
Unless you are unluckier than the unluckiest investor of the last 30 years, 10-year investment time frame, then you might have lesser return than 10%. That's point two. Point three is equity markets behavior is volatility. People get very perturbed with volatility, but you don't have to be perturbed. Last 21 years in this century, every single year, market has average fallen 20% from peak to trough. Still, it surprises people when it falls. Yeah. It has to fall. That's the nature of the beast. Accept that nature, embrace it, and make 3 times, 4 times more than FD return. It's as simple as that.
Right, absolutely. And now let's come to the diversification part. I mean, it is also absolutely important for better returns. And it is always a good idea not to put all your eggs in one basket. So what are the factors one should consider for diversification?
See, for diversification, you need a return target. Yeah. What's your target on return? What's your target on risk? That's the first. Risk, unfortunately, people measure in English, not in mathematics. At Anand Rathi, we measure it in mathematics. Like English words are used like high, medium, low when they're describing risk. When you describe return, they give it in integers. In risk, it is generally spoken in English, which is not right. Both sides of the coins have numerical measures and both have to be measured. For example, we tell the clients that at least 12% per annum return on your overall portfolio is important. Yeah. And to achieve that, you need a certain asset allocation, and the risk you will take is going to be 7 standard deviation, 8 standard deviation. What does that imply? We will come to that. For point one is decide your return objective, decide your risk limit numerically. That's step. Step 3 is bring clarity in your mind of what are the assets you wish to use and call them as assets. According to us, there are only 4 assets which have stood the test of time. Okay. Equity, debt, real estate, in precious metal also only gold. These have stood the test of time. That's the third thing. Do you want to use crypto as an asset? Do you want to use art as an asset? All that are decisions you have to take before you get to diversification. Most people get very lured to budding assets which die their natural death several times. So only 4 assets have stood the test of time. 2 of them can beat inflation for you, equity and real estate. 2 of them can be as shock absorbers to your car, gold and FDs or debt. So this clarity, return, risk, which are the assets you call assets, and then comes the asset allocation and the diversification too.
Yes, absolutely. I was coming to that only. So what is actually the ideal asset allocation strategy according to you, and how to invest, in various asset classes efficiently?
Yes. So to my mind, in the contemporary situation where we stand today,
Yeah.
for goals upwards of 5 years, you should have at least 60% in equity.
Okay.
Okay. 40% in debt.
Okay.
Real estate as an investment, to my mind, should be zero.
Okay.
Gold, currently, I will still keep it at zero. Okay. So equity and debt, with this mixture of 60 and 40, you can get an expected return of double digits.
Okay.
If you are having a 10-year plus objective, you can look at 80 in equity and 20 in debt.
Okay.
If you have 10 years, you have nothing to be worried about interim volatility.
Okay, absolutely. And also, what is your outlook on the Indian mutual fund industry? Any top mutual funds that you would like to recommend to our viewers to invest in 2022?
Yes, Tanya, I think that's a question which requires a lot of detailed research, which has been done, thankfully. So I'll give you the answer to that. Yeah. There are about 480 funds which are open-ended, which do equity investing.
Okay.
Out of that, you can, as an investor, pick 8, 10, or maximum 11. Yeah. So in our portfolio, we have 11 fund basket, which we choose not from the past performance standpoint, but we use statistical tools to try and see which could be potential future performance. On that whole model of 11 parameters, plus a target NAV concept, which we follow, we calculate the target NAV of each fund to help us relatively evaluate two funds in question. I will mention 5 schemes because most retail investors don't have that kind of wide portfolio to use 11 schemes. 5 schemes from 5 different categories is very critical, not same categories. In the FlexiCap category, use HDFC FlexiCap, Kotak Emerging Equity on the mid-cap side. Okay. On the small cap side, Aditya Birla Small Cap. On the contrarian bet, SBI Contra. In a focused fund, I would say ICICI focused equity fund. These 5 funds with 5 separate categories, if one bought, he would automatically or she would automatically have 130 stocks in their portfolio with 5 different styles of fund management and 5 different categories, which would be reasonable diversification for the equity portfolio. So on the debt side, our belief is you can, in today's contemporary situation, you can make your life very simple by lending to Government of India through a mutual fund, because the Government of India's return is significantly more lucrative than corporate India's return. And you're not being given enough extra return to lend to a large corporate. So a IDFC Gilt 2027 index, as specific as it could get, is a fund which can give you 6.3% post-tax, which is as good as a 10% fixed deposit for a highest tax bracket individual.
Okay, absolutely. So very well explained. Now let's come to the importance of goal-based investing. Since you are with us today, I would like you to share your mantra to become a crorepati in 10 years.
Okay. See, if you have to be a crorepati in 10 years, firstly, the target is very reasonable.
Right.
Okay. It is very reasonable because if you said in 5 years, then it becomes quite a stretch.
Absolutely.
So first thing, if you have to achieve a target, investing is about income minus expense. And then people invest the residual. If you have a goal in mind, like 1 crore in 10 years, you have to keep expense secondary. Income minus investment, whatever is left is you have to live in that means. So first is have a ratio of at least 30 to 40% of your total credit to bank as your investment tax. If you can do that, then you will be able to meet targets. What people do is first they have their incomes, they spend money, and then whatever is left, they say, how much SIP can I do? It has to be reversed. That's first tip. Second is you will have to have aggressive equity allocations, especially if you're investing in a staggered fashion. Don't be worried to have 100% in equity in an SIP format. That's the second mantra of getting closer to a crore. Third is make sure that you don't stay static in mutual funds, same mutual funds forever. Every fund goes through a cycle. if your distributor or advisor can tell you when to get out of a fund, is a good idea. Equity is long-term. That does not mean you hold a mutual fund, same mutual fund for 10 years.
Right.
For example, Prashant Jain has been in the talks because of his decision to step out. In 2015, Anand Rathi Wealth decided to exit out of Prashant Jain's schemes and re-entered the same Prashant Jain schemes in 2020. And that was the bad period of a god of wealth money management, which was Prashant Jain. Right. So if Prashant Jain can have a 5-year lull period, it's great. And if a distributor can identify that lull period, exit and re-entry, then that's the fourth tip. I see several people who do an SIP for 10 years in the same scheme without even bothering to review it.
Absolutely. And lastly, before we let you go, I mean, what would be your advice for all the young and new investors? I mean, markets are volatile at this point in time. So any mistakes that they should avoid?
They should avoid the mistake of learning from parents when it comes to investing.
Okay.
Like you see in the US, if the GDP is 100, mutual fund AUM is 140.
Okay.
US's mutual fund AUM is 1.4 times its GDP.
Okay.
Why is that? Because ancestrally in the US, equity has been invested. In India, if our GDP is 100, we have only invested 16 rupees in mutual funds. Because our parents, I didn't invest in equity for the first 4 years of my career because my dad talked me out of it. I have 100 other things to learn from him. I'm not undermining his skill of teaching me. But investing, we have been in love with physical assets ancestrally. Don't get too swayed by it. Start early. Second, don't get lured when your friends come and tell you that I made so much money. Because friends will only tell you when they make money. When they lose money, they'll just not tell you. Right? So you have a survival bias in that. So don't listen to your friends and lure you into a fear of missing out. Invest early. And don't go with the asset allocation of your ancestors.
Absolutely. That's the advice coming in. And on that wonderful note, thank you so much, Mr. Azeez, for joining us, for taking the time out for us and being with us here on ET Markets. Thank you so much.